The world as we know it could be on the brink of an economic transformation, and it all starts with a significant move by the United States. The U.S. has raised tariffs on goods from major countries, and the ripple effect is set to shake the global economy to its core. But what does this mean for you? Are we heading into a new global crisis, or could this be an opportunity to profit during turbulent times? As tensions rise between the U.S. and China, with the potential for global retaliations and higher costs for everyday goods, now is the time to understand the impact on your investments. Inflation, the stock market, and even the value of your dollar are all on the line. So, what can you expect? Will we see a repeat of the 2008 financial crash, or is there a way to navigate this storm successfully? Stay tuned as we dive into the complex web of tariffs, trade wars, and the potential financial chaos awaiting the world economy. This is not just about the US versus China, it's about the future of the global economy and your financial future. Are you ready for what's coming? Why is the US increasing tariffs on major countries? When we talk about the US increasing tariffs, it's not just about raising prices on imported goods. What's happening is that the United States is using tariffs as a way to pressure other countries, especially China and Europe, into changing their trade practices. These tariffs, or import taxes, are a form of economic warfare. The U.S. claims that it's being harmed by unfair trade practices, like subsidies and currency manipulation, particularly from China. For many, this is seen as a way to force changes in trade agreements. But the real question is, what will the long-term effects be? Which sectors and products will be most affected? Unfortunately, not all industries are affected the same way by tariffs. Technology products, like smartphones and computers, are likely to get more expensive. This is because many of these products are manufactured in Asia, particularly China. Additionally, items like automobiles and even imported food will see a rise in prices, directly impacting consumers' wallets. If the U.S. government continues to raise tariffs, we'll likely see global inflation accelerate in 2025. For anyone planning to buy a new smartphone or car, it's time to prepare for higher prices. The bigger question is, how will these price hikes impact your investments? How could tariffs affect investments in the future? The trade war and tariff hikes also have a direct impact on the financial markets. Many companies that rely on imports from other countries will see their profit margins shrink due to the increased import taxes. This could result in a decline in the stock prices of those companies. When this happens, the dollar might strengthen, which in turn affects companies that need foreign currency. During uncertain times like this, investors worried about a global financial crisis or a 2025 global recession could see more market volatility. Which brings us to the crucial question, where should you invest during a crisis? While the outlook may be uncertain, there are always opportunities for those with the right strategy. Will China, the European Union, and other countries retaliate? When the U.S. raises tariffs, a response from the affected countries is almost inevitable. China, for example, has already made it clear that it will retaliate with its own tariffs on American goods. This type of trade retaliation creates a dangerous escalation, where each move triggers a counter-response, making the situation even more tense with every passing day. The European Union is also unlikely to sit idly by, especially considering the products it exports to the U.S., such as automobiles and technology. The fear is that this dispute could escalate into a global trade war, with global sanctions that impact everyone's economy. The big question is, how far can this tension go before it turns into a full-blown global economic crisis? Possible sanctions and retaliation against the U.S. in response to tariff hikes, countries like China, the European Union, and even emerging nations might begin to impose trade sanctions against the U.S. These retaliations could have devastating impacts not only on the US, but also on countries that rely on trade with the American giant. China, for instance, could start restricting the import of agricultural products from the US, which would directly affect the US agricultural industry. Moreover, as tariffs rise, other countries might increase the cost of imported goods from American companies, which would hurt both consumers and American businesses. This could impact the stock market as companies report negative financial results with a decline in profits, affecting their share prices. How could this trade war affect Brazil? For Brazil, the consequences of a global trade war could be both negative and positive. On one hand, Brazil might face a rise in prices for imported products due to the tariffs imposed on goods from countries of origin. This would put pressure on global inflation, impacting the local economy. On the other hand, Brazil could benefit from foreign investments fleeing more unstable markets, as many investors might seek emerging countries with lower risk, like Brazil. Additionally, with the US-China economic dispute, there might be more export opportunities for markets seeking alternatives to Chinese products. The situation is constantly evolving, and the outlook for the financial market could present great opportunities, but also major risks. Could the stock market fall? What happens to the dollar? The impact of the trade war and increased tariffs can be felt quickly in the stock market. When tariffs are raised, companies that rely on imports from countries like China and Europe are likely to see their profit margins shrink. This usually leads to declines in their stock prices. For investors, this is a red flag, as it signals that the stock market could experience more volatility. On the other hand, the US dollar could strengthen in response to these changes, as investors flock to safer assets in times of economic uncertainty. But while some currencies rise, the global impact on markets may trigger inflation and disrupt investment flows worldwide. Will commodities like gold, oil, and soybeans spike? Commodities often behave differently during trade conflicts. While some investors may focus on stocks or bonds, commodities such as gold, oil, and soybeans might experience spikes in demand. Gold, traditionally viewed as a safe haven asset, often rises in price when the global economy is under strain. In times of uncertainty, people want to protect their wealth, and gold is usually the go-to asset. On the other hand, oil prices may fluctuate, as restrictions on trade or tariffs can disrupt supply chains. Soybeans, for example, are often at the mercy of trade relations, particularly with China, a major importer. If tariffs are imposed on US agricultural products, countries like Brazil could see increased demand for their exports, impacting the global commodity market. How can you protect your investments during a trade war? Investing during a trade war and global economic uncertainty is challenging, but it's also an opportunity for those who know where to look. Diversification is key. Don't put all your eggs in one basket. One strategy is to invest in assets that can hedge against inflation, like real estate or precious metals. These tend to hold value when other markets are volatile. If you're unsure, you might consider exchange-traded funds, ETFs, or bonds that focus on global growth and offer protection against a financial crisis. Remember, even during a global recession, there are always sectors that thrive, so identifying industries with resilience can protect your wealth in the long term. Will smartphones, cars, electronics, and food become more expensive? The hike in tariffs by the US can lead to higher prices for many products, both in the US and globally. For example, smartphones, cars, electronics, and food that are imported from countries like China or Europe could see an increase in their prices. Consumers will likely feel this impact in their daily purchases. Products that rely on global supply chains are especially vulnerable. If tariffs on Chinese electronics or European cars increase, the cost to consumers will rise. The same can happen with food items, especially when agricultural exports are involved, further contributing to the inflationary pressure. This could impact the cost of living for people across the world, particularly in countries that rely heavily on imports. Global inflation and possible trade crisis as tariffs push prices higher. Global inflation could spiral. The U.S., as one of the largest economies, has the power to influence global prices. When the cost of imports rises, manufacturers in other countries have to adjust, passing those costs on to consumers. This creates a ripple effect around the world. Many countries may face rising inflation rates as their local economies adjust to the new pricing structure. Developing nations, especially emerging markets, could suffer the most, with Brazil, India, and other countries bearing the brunt of this price surge. As a result, it could lead to a trade crisis, especially for nations that rely on importing essential goods. What impact will this have on Brazil's economy? For Brazil, the new tariffs might lead to a double-edged sword situation. On the one hand, Brazil may face rising costs for imported goods, especially in sectors such as technology, automobiles, and agriculture. This could add pressure on inflation and hurt the purchasing power of consumers. On the other hand, Brazil could benefit from increased demand for its exports, particularly in commodities like soybeans, coffee, and beef, as countries like China seek alternatives to U.S. goods. The economic shift could lead to new trade opportunities for Brazil in a changing global market. However, these potential benefits come with risks as the global economic environment becomes increasingly uncertain. How could this dispute affect the global balance of power? The U.S.-China trade war isn't just about tariffs, it's about reshaping the global economic order. The U.S. and China are the world's two largest economies, and their rivalry has major implications for global trade and investment flows. As the two nations engage in a bitter economic battle, they are reshaping alliances and trade networks. Countries are now being forced to pick sides, either aligning with the U.S. or the Chinese economy. This tension creates uncertainty in the global market as it threatens the stability of the global economic system. The shifting power dynamic could alter the future of global commerce, making it a critical issue for investors and governments alike. What's at stake for the future of major global powers? This ongoing economic dispute between the U.S. and China could lead to a realignment of the world's economic power. As both nations struggle to assert dominance, smaller economies will feel the impact. Emerging markets like Brazil, India, and others could either benefit from this competition or be caught in the crossfire. For instance, some countries could step in to replace China in the manufacturing sector, while others may see new opportunities in the global supply chain. However, the trade war may also push for a multilateral world order, where economic ties are less dependent on the U.S. or China and instead spread across regional alliances. This could shift the economic power from the traditional powers to more diversified blocs. The future of global economies in a U.S.-China conflict as the U.S.-China trade war continues. Both countries will face serious economic consequences. While the U.S. might experience short-term gains from higher tariffs, the long-term implications could hurt its manufacturing sector and global competitiveness. On the other hand, China could be forced to shift its economic model, moving from export-driven growth to more domestic consumption. This could disrupt global supply chains, affecting everything from electronics to textiles. The war could even impact investment patterns globally, with investors looking for safer assets like gold and government bonds. Ultimately, the outcome of the U.S.-China economic battle will have far-reaching consequences for economies around the world, with no clear resolution in sight. Could the European Union enter a recession? The European Union could face significant economic challenges if the trade war between the U.S. and China continues to escalate. As the U.S. raises tariffs on foreign goods, European companies that rely heavily on exports to the U.S. may see a decline in demand for their products. This could lead to an economic slowdown as businesses cut back on investments and production. Additionally, Europe has already been struggling with low growth rates, and a further disruption in trade could push the region into a recession. The European Central Bank (ECB) may have to implement more monetary stimulus to try and keep the economy afloat, but it remains uncertain whether these measures will be enough to offset the damage caused by the trade conflict. How could emerging markets like Brazil be affected? Emerging markets, including Brazil, could experience both positive and negative effects from the US-China trade war. On the one hand, Brazil could see increased demand for its agricultural products, such as soybeans, coffee, and meat, as China may seek to diversify its imports away from the US. However, if global inflation rises due to higher tariffs, Brazilian consumers could face higher prices for imported goods, leading to greater economic pressure. Additionally, if the global economy weakens and trade flows slow, emerging markets could suffer as foreign investors may pull their capital out in search of safer havens. This volatility poses both risks and opportunities for countries like Brazil, which will need to carefully navigate the economic changes. What does this mean for Brazil's future in a globalized world? For Brazil, the challenge will be to balance the opportunities presented by increased exports to countries like China with the risks of rising inflation and imported costs. Brazil's reliance on commodity exports might provide a cushion in the short-term, but if the global economy slows down, the country could feel the pinch in areas like manufacturing and infrastructure. The country's economic resilience will depend on its ability to adapt quickly, whether by securing new trade agreements or shifting its focus to different markets. Brazil, like other emerging economies, will need to position itself smartly to take advantage of the changes in the global economy while also preparing for the potential downsides of an increasingly fractured world economy. Can the Federal Reserve Fed intervene to prevent a crisis? The Federal Reserve Fed plays a crucial role in stabilizing the U.S. economy during periods of economic uncertainty. If the U.S. trade war continues to deepen, the Fed may be forced to act to prevent a full-blown economic crisis. The Fed could lower interest rates to stimulate borrowing and investment or implement quantitative easing to increase the money supply. However, the Fed's ability to respond effectively is limited, especially when dealing with inflation caused by higher tariffs. The challenge is that these measures may not have the desired effect if the global trade environment continues to be unstable. As a result, while the Fed can certainly help stabilize markets in the short term, it may not be able to avoid a long-term crisis. Can the European Central Bank (ECB) prevent a debt crisis? The European Central Bank (ECB) also faces significant challenges as it tries to manage the economic fallout from the US-China trade war. European economies are already struggling with high levels of public debt, and the ECB might face a new crisis if trade tensions result in a global recession. If the European economy slows, the ECB could be forced to implement more stimulus measures, such as lowering interest rates or increasing bond purchases. However, the ECB's efforts might be complicated by the debt levels in some EU countries, which could create a debt crisis in regions already facing financial instability. As Europe continues to deal with its internal problems, the ECB's ability to prevent another debt crisis could be severely tested. How do central banks shape the global economy in times of crisis? Central banks like the Fed and the ECB are often the last line of defense in times of economic turmoil. Their decisions on interest rates, monetary policy, and financial stimulus have far-reaching consequences. When tariffs disrupt the global economy, central banks must balance the need for economic growth with the risks of inflation. Their decisions can affect global investment flows, influence the value of currencies, and determine whether markets remain stable or crash. During a global recession, central banks will have to be particularly careful, as their actions can either exacerbate the crisis or help ease the economic pain. Investors must keep a close eye on central bank policies, as they will have a significant impact on the future of the economy. Should investors worry or seize the opportunity to buy cheap stocks? The stock market is often one of the first places where the effects of a trade war are felt. As the U.S. increases tariffs and economic uncertainty grows, many stocks could experience a sharp decline. While this may seem like a reason to panic, it could also present a buying opportunity for investors looking to capitalize on low stock prices. Some investors might see this as an opportunity to buy shares in companies that are temporarily undervalued due to the trade tensions. However, it's important to approach these opportunities with caution, as the market's volatility could lead to further downturns before any significant recovery. So, investors need to carefully assess which sectors are likely to recover and which could continue to suffer. Which sectors could suffer the most or benefit? The sectors most vulnerable to the trade war are those directly impacted by tariffs and import-export restrictions. For example, companies in technology, automotive, and agriculture could see significant declines in their stock prices as costs rise due to increased tariffs. On the other hand, companies in industries like energy, precious metals, and defense might benefit, as their products are less reliant on global supply chains. Gold and oil stocks often see an uptick in times of economic instability, as investors flock to safer assets. Similarly, defense companies may see increased demand as nations invest more in security during uncertain times. The key for investors will be identifying which stocks are poised for growth despite the overall economic turbulence. Should investors focus on long-term or short-term strategies? In times of economic uncertainty, many investors are torn between short-term speculation and long-term investment. While it's tempting to try and profit from the market's volatility, it's important to consider the long-term impact of a trade war on global markets. If the U.S.-China trade war continues, the economic landscape could be fundamentally changed, making some short-term strategies less effective. Investors who adopt a long-term approach might focus on building diverse portfolios that include stocks from sectors with strong growth potential. These might include companies that are likely to withstand economic shocks and emerge stronger. The key is balancing the risk of short-term market swings with the stability offered by long-term investments. Is this the beginning of a global crisis, like 2008? The possibility of a global recession looms large as the U.S.-China trade war escalates. The last global financial crisis, in 2008, was triggered by issues within the banking sector, but this time, the global trade system is at the center of the storm. As tariffs increase, global supply chains are disrupted, and countries face rising inflation. The fear is that we might be headed toward another widespread economic downturn. While it's hard to predict whether this will be as severe as 2008, the signs of economic slowdown are evident. Central banks around the world are already taking action, but there's a sense that the global economy could face a major crisis unless tensions ease quickly. What can countries do to avoid an economic collapse? Countries around the world are watching closely to see if the U.S.-China trade war will result in a global economic collapse. Many are hoping that diplomatic negotiations can lead to a de-escalation of tariffs and tensions. However, even if this happens, the economic damage already done could take years to recover from. Countries will have to be strategic in their economic planning, focusing on stimulating domestic growth, securing new trade partnerships, and diversifying markets to avoid being too dependent on the U.S. or China. The global economy is increasingly interconnected, so small changes in one country can cause a domino effect. It will be critical for governments to implement effective fiscal policies to protect against economic shocks. Can we expect a recovery, or are we entering a long-term recession? The future of the global economy depends on many factors. The escalation of the US-China trade war, combined with the impact of inflation and higher tariffs, could lead to a prolonged period of economic stagnation. However, there is hope that the global economy could eventually recover as governments and businesses adapt to new trade dynamics. Technology and innovation might play a key role in this recovery, offering new solutions to global challenges. While it may take time, many experts believe that the world will eventually find a new equilibrium, though it's unlikely that things will return to the way they were before the trade war began. The path to recovery will be difficult, and it will require a lot of international cooperation and strategic planning. Strategies to protect your money and investments. In times of economic uncertainty, especially during a trade war, it's essential to have strategies in place to protect your wealth. One of the best ways to shield yourself is by diversifying your investments. Don't put all your eggs in one basket. This means spreading your investments across different asset classes, such as stocks, bonds, commodities, and even real estate. Diversification helps to minimize risk in volatile times, as not all sectors or markets will be equally affected by tariffs and trade disruptions. Additionally, consider investing in safe haven assets, such as gold or government bonds, which tend to hold their value during economic downturns. By diversifying and protecting your assets, you'll be better positioned to weather any financial storms that come your way. Where to invest during uncertain economic times? While the trade war may cause many markets to fall, it also presents opportunities for savvy investors. Certain sectors, like technology, especially companies that benefit from the shift to digital and automation, energy and precious metals, could see growth during this period. Gold and oil often perform well in times of economic instability as investors seek safe investments and commodities with tangible value. Additionally, companies with strong balance sheets and those that can adapt quickly to global changes may outperform others in this environment. It's essential to focus on resilient companies and industries that have the potential to thrive despite the challenges posed by the trade war and economic volatility. Protecting your money from inflation and global risks. Inflation can be one of the biggest threats to your wealth during a trade war. As tariffs raise the cost of imports, prices on everyday goods and services could increase, diminishing your purchasing power. To protect yourself from inflation, consider investing in inflation-protected securities, such as TIPS, Treasury, inflation-protected securities, or commodities like gold that historically perform well during inflationary periods. Another effective strategy is to keep a portion of your wealth in foreign currencies or international investments, which can act as a hedge against a weakening dollar. By staying proactive and adjusting your investment strategy based on current economic conditions, you can not only protect your wealth, but also position yourself to take advantage of the opportunities arising from the trade war. As the world enters a new era of trade tensions and economic uncertainty, it's crucial to stay informed and prepared. The U.S. tariffs and the escalating trade war have the potential to reshape the global economy, and your financial future depends on how well you navigate these challenges. While the risks are high, there are also opportunities for those who understand where to invest and how to protect their assets. Whether you're looking to diversify your portfolio, explore new investment opportunities, or safeguard your wealth from inflation, the time to act is now. So, how will you position yourself in this ever-changing landscape? Will you wait for the storm to pass? Or will you take charge of your financial destiny and make the most of these uncertain times? The path ahead might seem daunting, but with the right strategies and mindset, you can come out ahead. If you found this video valuable, don't forget to subscribe, hit the notification bell, and stay updated with the latest insights on how to protect your money and invest wisely in these Challenging times. The future may be uncertain, but your ability to navigate it doesn't have to be.